right, good morning, everybody. I want to welcome you to our continued In the Trenches series. Once again, we are turning our attention to the Main Street Lending Program, and we'll be focusing on multiple aspects of the program, and particularly the terms of the program, some of the information for those of you who may be considering participating in it as a borrower, as well as concerns for those who may be participating in the Main Street Lending Program as a lender. Like last time, I am proud to be joined by two of my colleagues who are not regulars on the In the Trenches program. Most of you know me. This is Brad Rustin as well as Craig Nazaro, both of us in the Financial Regulatory Group and regular presenters on In the Trenches. I'm joined today by both John Talcott and Peter Strand, who are also have a large focus on the financial services industry, but really focus on securities, structured finance, M&A, as well as securities offerings. And, I'm particularly proud to introduce John Talcott, who had experience working with the prudential regulators during the S&L crisis, and a lot of that is guiding how we think about the Main Street Lending Program, and a lot of his experience is guiding how we really kind of consider the Main Street Lending Program, how it is going to be deployed, or at least how we think it's going to be deployed, and what the different concerns are for both the borrowers and lenders under the program. As we talk about the Main Street Lending Program, it's really kind of a way that we can structure our presentation today. But we're going to first talk a little bit about Title IV of the CARES Act. Those of you who joined us for our last program may recall that there are some interesting kind of aspects of the Main Street Lending Program that develop because of how it is created under Title IV of the CARES Act. It is fairly unique in that it is a Federal Reserve participation. Because of the nature of how this program is structured, there are some unique considerations that come about under the CARES Act. We'll then talk about the three facilities that have been created, including the new facility that has been created in the latest guidance that was issued over the weekend. We'll then talk about eligibility and restrictions, application processes, and processes, and then last we'll be talking about lender implementation. As we go through today, I do want to encourage you, there is a question function inside of GoToWebinar. If you have questions, feel free to shoot those to us as they come up. We'll try to address those as we're working through the presentation today. We had a very lively audience when we first introduced the Main Street Lending Facility programs. Would encourage you to also ask questions today. We're happy to try to address those as we move our way through. So with that, I'll now turn it over to John and Peter, who are going to give us a little bit of information on the updates to the program and an overview of the Main Street Lending Facility.
Thanks, Brad. Yes, so some of you heard us speak about the Main Street Lending Facility before. The process by which this was is being put into place has been kind of slow motion. They've had March 23rd, there was an announcement that the Fed was going to have a Main Street Lending Facility. And then March 27th, the CARES Act was passed, and it incorporated the concept of the Main Street Lending Facility. There was, initial term sheet put out on April 9th. Then on April 30th, they announced a kind of more detailed approach to it. And, I guess at some future date, they'll actually enact it. Go to the next slide, please. So it's important to look at this in context. The CARES Act, also known as the stimulus package, has been a means by which Congress has tried to help the economy in light of the COVID-19 crisis. They've allocated something like $2 trillion to various initiatives. And some of those initiatives, like the Paycheck Protection Program and its, associated SBA lending programs, are, very familiar to people and really cater to the smallest of businesses with 500 or fewer employees, generally speaking. The CARES Act also, in Title IV, attempted to address other industries or other businesses. And, it started off by allocating some funds to the Treasury to give directly to the airline industry and its related businesses. And that's about $46 billion. And then it also provided $454 billion for lending to the financial system, broadly speaking. Next slide, please. So they have the Treasury, when it tries to put the money to work, is most likely to be putting it to work through the Fed. That way the Fed can lever up the money that's being put to work. When the money is being put to work by the Fed, it's restrained, its ability to put it to work is restrained somewhat by Section 13.3 of the Federal Reserve Act, which provides that, basically the Fed can't put it to work in a way that's not consistent with market practice, and also can't be lending money to insolvents, and can't be granting money or forgiving money. That's significant when you look at the Main Street lending program and compare it to, say, the PPP. The PPP is set up specifically to be a program that allows for grants directly to small businesses that are forgiven loans that are never having to be repaid. Next slide, please. So the most recent, what you're going to see here is in blue we've put kind of information that's new, and in black is what the original information was we presented in our last presentation. The reason why we did it this way is to show that, as of April 30th, when the Federal Reserve, issued initial guidance, the program has become much more kind of focused. It's somewhat expanded, but not really. It's the same amount of money. It's expanded in the sense that they try to make more businesses eligible, but it's really also narrowed because they put in place eligibility requirements that shrink the number of people that businesses are eligible. So it's kind of an interesting development. On this slide, we kind of list out the various types of Federal Reserve programs that have been put in place. And I think for context, it's important to focus on this. We have the primary market corporate credit facility, the secondary market corporate credit facility, the term asset-backed securities loan facility, the money market mutual fund liquidity facility, and the commercial paper funding facility. These are all, as you might guess, very much market-related facilities. In the past, say in the 2008 crisis, the focus of the Fed has always been to make sure that there's liquidity in the quote-unquote financial system. What does this mean? It means that basically the markets, the debt markets up in New York in particular, continue to function correctly during this time of crisis. And in order to do that, the Fed has become quote-unquote the lender of last resort. And by putting in place these 5 particular programs, they're trying to say, look, there isn't anybody who's going to want to raise money for themselves, or any commercial paper program, any money market program, anytime somebody wants to issue asset-backed securities, anytime there's going to be a market for corporate debt, whether it's primary or secondary, there's never going to be an instance where there isn't a market, there isn't a buyer for that type of debt. There isn't somebody who will lend money against that obligation. So that's what these 5 facilities do. I focus on them for a moment because the Main Street lending program is radically different than anything the Fed has ever done before. The only thing that's somewhat similar to it that's also new is the primary market corporate credit facility. Primary market corporate credit facility is only for investment grade companies, and you borrow directly from the Fed. It's basically, if you're an investment grade company, you want to lend in the bond market or raise money in the bond market, you issue some bonds to the Fed if you can't issue them to anybody else. That is a very kind of narrowly focused if you're just the kind of normal mid-sized business. And that's where the Main Street lending program comes into play. It's put in place to meet a need above small businesses, but below the giant national or multinational corporations. As you can see here, as of April 30th, the program has been modified a little bit. Used to be a new loan facility and the expanded loan facility. Now they put in this priority loan facility. The way to think of this expansion is just to say they now have 3 facilities. In other words, 3 ways that banks can lend money and then turn around and get it financed by the Fed. And 2 of those 3 ways, the new loan facility and the priority loan facility, are for new lending. In other words, lending that isn't piggybacking on an existing loan. And the 3rd way continues to be an expanded loan facility. Let's go to the next slide. So this basically talks about the general terms of the Main Street lending program. They've got these 3 facilities. It's a situation where people borrow money from a bank. The bank turns around and lays off some of that risk to the Fed, and the Fed's going to take on that risk through a special purpose vehicle. $75 billion has been given to the Fed by the Treasury that came from the CARES Act allocation, the $2 trillion, and the Fed is levering that up to $600 billion. So they'll set up these three separate facilities, and each of them will function slightly separately. They're all going to be done through the Federal Reserve Bank of Boston. But basically, they'll take either 95% of a loan if it's one of the MSMLF or MSELF loans, or they'll take 85% of a loan if it's one of the MSPLF loans. There was an expansion of the eligible lenders definition in this most recent guidance that was put out. And basically, it allows foreign banks or entities controlled by foreign banks to also participate as lenders. Next slide, please. It's interesting, they say it expanded. You see in the press that this Main Street lending program was expanded. Well, it was expanded in the sense that now businesses that have up to 15,000 employees or less than, well, this should say $5 billion in annual revenue, can take advantage of the facility. So that's a significant change. There's instances where the holding company is going to have a lot of employees globally, and those employees will have to be counted. So it is important to note that the SBA regs have come into play. So in a couple instances, one of them is, it used to be, and we talked to some of our clients about it, that we thought that the Main Street lending program might be available to smaller bank holding companies to be borrowers themselves. But ineligible businesses from a borrowing perspective now are banks, life insurance companies, businesses engaged in illegal activities, as if that needed to be said. That would include, for instance, cannabis businesses cannot borrow under this. Gambling businesses cannot borrow under this. But basically, the takeaway here is that the Fed has, in trying to put together a program very rapidly that's like no other program they've ever put together, they've decided to piggyback off the SBA regs. And that's disadvantageous if you're a financial services company, because as a financial services company, you can't be a borrower under the Main Street lending program. So that's a significant change. Something that's been criticized is also that loans can only be made if they would be a pass in the FDIC supervisory rating system. I read in Wall Street Journal where they said, well, this is really going to limit it since a lot of the businesses are in bad shape. I think that it's yet to be seen how that's going to apply. Next.
John,
next.
Before you slide on, do you think there's going to be, like the PPP, the Paycheck Protection Program, any pushback given the expansion of the dollar values and the number of employees? I know the Journal has already posted a few articles saying companies like Equifax and NASDAQ may qualify, not saying they would be applying for these, but companies of that size and magnitude would be available to participate in the Main Street lending program. And there's already some pushback, certainly from certain sectors, saying, is that really Main Street businesses? And we're talking about these large, nationwide or international companies. Do you think there's going to be any pressure to reduce this, or do you think this is more in line with what the markets are looking for in terms of creating that liquidity?
I mean, this is just an opinion, but I can see where there might be some criticism, but I don't think it should stick. The problem they've got, the PPP and the SBA lending programs were specifically focused on, I don't know, the number you hear is, 75% of the jobs in the country are created by small businesses. I'm not expert in numbers of SBA jobs out there, or small business jobs out there, but clearly that was the focus of the PPP and those related programs. I think here the problem is much more systemic, in the sense that they're looking for a way to prop up or help businesses that are going to try and make it through the COVID-19, have been damaged by the COVID-19 crisis, through to the other end of the crisis. And frankly, I think this program is really aimed at saving the banks, because without a lot of help, you're going to see a lot of damage done to bank balance sheets in the next 3 or 4 months. And I think that's where this is aimed at. So I don't think there's going to be sympathetic ears at the Fed or at the Treasury when people start saying, oh, well, larger businesses are benefiting from this. Well, clearly that's the intention. This isn't This is an effort to fill the gap between the smallest businesses and those businesses which are investment grade and can access the capital markets, pretty readily, or can go through the primary market credit facility. If they don't do something like this, the number of bankruptcies across the country might start spiraling out of control. Next slide, please. So here, for those of you familiar with the new loan facility, this is for an entity that wants to borrow from a bank where they don't have existing credit outstanding with that bank, and basically, there's some significant changes here. This is for loans that originate after April 24th. That's a change in the sense that whenever the program starts, that's probably going to be the date there. It's gone from being measured against SOFR to being measured against LIBOR. LIBOR is much more of a traditional benchmark for setting interest rates on loans. People have to transfer over to SOFR in the next couple of years, I think by the end of 2021. But in the meantime, I guess the Fed has decided it's easier to implement this if they just use LIBOR. They reduced the minimum size from 1 million to 500,000. That was a direct response to a lot of criticism they got. Oddly enough, not from the borrowers, but really from the bankers who didn't want to be in a situation where they couldn't participate or they couldn't provide credit to their client because the loan was just too big for them to have on their balance sheet. Remember, any insured depository institution in the United States can be an eligible lender here. So that goes down to the smallest community banks in the country. So having a more flexibility on the minimum size is really meant to address those concerns. Interestingly enough, we have an attempt. The big problem in the original version of the Main Street Lending Program was that EBITDA was announced as one of the caps. So you have maximum size is either the lesser of 25 million or 4 times 2019 EBITDA was the original kind of way that was phrased. What we found with a lot of our clients was that cap was preventing them from borrowing. And so the Fed has attempted to address that because, there's certain, EBITDA doesn't really have a lot of meaning in certain industries. So they try to, address that by addressing what really counts as a, undrawn commitment with respect to a loan facility. If you remember, it's basically the way this formulation works, and you'll see it in an example that we have is, you figure out how many loans you have outstanding, then you figure out how much your EBITDA was, and you take the difference, and that's what's available to you. So here, where they're lowering effectively lowering the amount of debt that you have to use in that calculation, it's more likely that you'll have some headroom between the debt and the EBITDA so that you can borrow money under this facility. There's no prepayment penalty as there have, as it's been in the past. They talk about subordination. They don't want it subordinated to anything. And then they talk about amortization. The first year, there's no amortization. Then there's a year after that under the new loan facility. You'll see how this contrasts with the other loan facilities when we go through it. Next slide, please. Peter, do you want to walk through this example?
Sure, thanks, John. I do think it's helpful to put some numbers to the example to kind of illustrate how the program works in practice. The new loan facility example, let's say Company A has bonds outstanding $20 million, an undrawn credit line of $30 million, and 2019 adjusted EBITDA of $15 million. Therefore, the outstanding committed but undrawn and available debt equals $50 million. 4 times 2019 adjusted EBITDA would be $60 million. And so the EBITDA formula yields $10 million, which is the 60 million minus 50 million. The loan amount then is the lesser of 25 million in the EBITDA formula, which yields $10 million.
Next slide. So this is all in blue because this is all brand new. And to shorthand it, they basically wanted to provide a facility that would lend money to more risky companies. So the big changes here are from the Main Street new loan facility. For some reason, they decided to call this priority loan facility. That I don't know why. Maybe priority means the house is burning down, so we definitely need the fire trucks. I don't really know. But it does it's simply another way of getting a new loan from an eligible lender to an eligible borrower. And the math here has changed a little bit because now it's 6 times EBITDA that you use to figure out the cap. And there's also a different amortization, and there's also a different amount of participation by the Fed. The 6 times EBITDA cap you'll see in the example to follow it makes it you eligible for a little bit more borrowing. The amortization is a little more advantageous to the borrower. I mean, it's kind of putting off the bad news, right? So you've got more of a bullet feel to this, where nothing's due the first year, 15% is due the second year, 15% is due the third year, and 70% at the very end. And then the Fed takes less risk here. They'll only take 85% participation in these loans. The lender has to retain 15%. But that's, the fees are the same. The fees, are 100 basis points when you originate it, and then that's also 100 basis points has to be paid over to the facility, the SPV, and then 5 basis points of loan servicing going forward. Next slide, please.
So by example, if we use the same dollar amounts as the previous example, Company A has bonds outstanding $20 million, available undrawn credit line of $30 million, in 2019 adjusted EBITDA of $15 million. The available outstanding available undrawn debt equals $50 million. 6 times adjusted EBITDA would be $90 million. The EBITDA formula yields $40 million, and therefore their loan amount would be $25 million, or the lesser of $25 million, and the EBITDA formula. So clearly the difference between these two programs is the 6x EBITDA versus the 4x EBITDA, and it can make a significant difference.
And it also should be noted, when we're looking at these calculations, that because of the decrease in credit that has to be recognized as undrawn lines of credit, because there are certain exceptions that have been kind of put forward, or exclusions that have been put forward, that's also going to cause the amount that's available to be borrowed under these programs to be higher. Next slide, please. This is, a facility that was in existence in the previous iteration of the program, and basically, the expanded loan facility is premised on the idea that if you already have debt outstanding with a financial institution, the Fed is going to be more comfortable taking greater credit risk. Now, the interesting thing is there were certain problems with the way that was couched previously. Specifically, they didn't make it clear what it meant to have existing credit outstanding. So it sounded as if you had to have a term loan in place. Now you can have a term loan, or you could have, a revolving credit facility. So basically, you are now, if you have a lending relationship, is the way I see this, with or borrowing relationship with a bank, and you want to borrow money from that bank in connection with the Main Street lending program, it can be any kind of credit, basically. It's a term loan, revolving credit facility, credit line, any one of those. I don't know, letter of credit, maybe not. That's not clear, but it is clear that this has been expanded substantially by that. They changed the minimum size upwards. So, that makes sense in the sense that these are going to be bigger loans. They've changed the maximum size upwards. And that's also good. I think we'll see in the analysis that the net effect of that is that there's going to be more credit available. The amortization schedule has been made specifically like the amortization schedule for the priority loan facility, which is good. And here, because of the existing relationship, the Fed will actually take 95% off the balance sheet of the banks. So that's, this is all, I think, good news in the sense that it's going to be more easy to borrow money under this configuration of the program. Next slide, please.
The example is slightly different since the company will need to have outstanding debt with the eligible lender. Company B has a term loan outstanding of $20 million with an eligible lender. They have an undrawn credit line of $30 million and 2019 adjusted EBITDA of $15 million. Their outstanding committed undrawn available debt would be $50 million. 6 times EBITDA equals $90 million. The formula yields $40 million. The loan size then would be $17.5 million under these numbers. That's the lesser of $200 million, $40 million, which was the EBITDA formula, and then the $17.5 million, which is 35% of the outstanding committed and undrawn available debt.
Next slide.
There are required attestations from both the borrowers and the lenders, which kind of impose additional terms on the programs. Borrowers will need to state that they have the financial ability to meet obligations for at least 90 days after the loan, and this is pro forma, giving effect to the loan. And they do not expect to file for bankruptcy during that time. Previously, they had to attest that financing was required due to exigent circumstances presented by COVID, so that standard has changed slightly. What remains is that they may not use the proceeds to repay other loan balances unless they are mandatory and due, except that the priority loan fund may be used to refinance certain debt at the time that the loan is made. The borrowers must also not seek to cancel or reduce any existing lines of credit and must follow statutory restrictions on stock repurchases, dividends, and executive compensation. Those limitations for stock repurchases and dividends are for the term of the loan plus an additional year, and the executive limitations are for the term of the loan. The lender must also make attestations, and they must attest that the proceeds will not be used to repay or refinance borrower debt at that bank, and they will not cancel or reduce any existing lines of credit of the borrower. They must also attest that the methodology used to calculate adjusted EBITDA is consistent with past practices.
Next slide, please. So there are a few issues that kind of have already started popping up. The question is, will you have entity level financials in order to qualify for this program? Some people who will be applying for this are wholly owned subsidiaries of larger entities. And, the question presents itself, have they had financials that are separate and apart? Peter, do you want to speak to the foreign ownership issue at all?
Yeah, this is an application of the SBA regs that's still a little bit uncertain. So as John described earlier, the way you count whether you're under 15,000 employees or 5 billion in annual revenues is affected by SBA affiliate rules. So when you're counting those employees or counting the revenue, you must also count the employees or revenue of your affiliates, which is, and the Fed has decided to piggyback on SBA regs. SBA regs say that you must look at common control. So basically any one that owns 50% or more of the borrower. You must look at any other entity that they also control. You can also, if there's no 50% or more owner, you also look at common management to determine control. And you have to aggregate all of the employees and or revenue of all those affiliated companies. So in certain corporate structures or ownership structures, the number can get quite high quite quickly. The Fed term sheets and FAQ for this new program or updated program have said that they will rely on the SBA regs as modified by the various interim rules and guidance for the PPP program, and that may or may not bring in the concept of counting only U.S. residents for the purposes of the employee test. There's a bit of a gray area as applied to the PPP, and there's a much larger gray area as applied to the Fed program, whether those foreign employees will be counted or not for the purpose of that rule and the SBA affiliate rules.
I think it's probably worth highlighting what Peter's saying there. So under the, there was originally under the PPP a general acknowledgement the SBA rules would apply with respect to foreign ownership. Then the Treasury under the PPP said, oh, no, you can't be more than 20% owned by a foreign entity. Then the Treasury said, oh, here's our application. It says the same thing. Can't be more than 20% owned by a foreign entity. Then they issued another application where it said, oh, we're just going to fall back on the SBA rules. So which speak in terms of foreign ownership, being permissible as long as you had, a principal business here in the United States. Now, that means that foreign ownership really isn't the issue here. The issue is, how do you count the employees? Well, under the PPP, there's language in some of the guidance that says specifically to count up to 500, which is the threshold for you can't have more than 500 employees and take advantage of the PPP unless you fit under some other small business measurement. That's another kind of conversation. But in that phrase, they said that have the principal place of residence in the United States. Well, that's new language. That's not traditional SBA language. That's new language that's been added through guidance provided specifically with respect to the PPP program. And probably relates to their desire to get as much money as possible out into the hands of American employees as possible. So under this program, if you use the traditional counting method, you wouldn't just focus on the entity, its employees in the United States, and its affiliated entities with their employees in the United States. You would focus on all the employees everywhere, and that's under the traditional SBA analysis. So the question is, does the PPP analysis hold true? Is that the one we should be focusing on, or should it be the traditional SBA analysis? If you have a question about this, you should dial us up directly, and we'll let you know what we know. As of the day that we're asked the question, because it's liable to be subject to further guidance going forward. But it's an important thing to focus on. We've already had a couple of clients who said they can't participate because they have too many employees globally. Another thing on this list is eligible businesses. We've discussed that previously. There's basically a list of ineligible businesses for businesses that cannot apply under traditional SBA programs. The most obvious of which is financial services companies. So again, if you had the idea that you're going to borrow into this program and you're an asset manager or you're a bank or you're a BDC, it's not going to be available to you.
It's also not available to nonprofits at this point, but the Fed has said that they're looking into a separate program that will help 501c3s and other nonprofits.
John, we did get a question in from the audience I was going to raise with you, which is someone asked, can the proceeds of a priority or expanded loan be used to repay the balance of a term loan at the lending bank if that term loan comes due at or just after the funding of the program loan? Meaning, could you take some priority loan facility or expanded loan facility and pay off a term loan that's terming out either at or just after the funding of the program loan?
I think the answer to that is no. Peter, do you have a view on this?
Well, you couldn't get a priority loan if you had a term loan at that bank. You'd have to go through the expanded loan program, and then the expanded loan program itself has the term requirements, 4-year terms and so on. So I'm not certain, but
I think the short answer is no, you can't do that. Yeah. Because you're supposed to attest that you're not going to be using it to pay out the borrower. The lender has to attest that it's not going to be used to pay off an existing loan facility. the proceeds aren't. So, if you do it shortly thereafter, I think one thing that's important to underscore here is that you aren't going to want to be skating right up close to the line. These programs are going to get a good hard look once things settle down and the economy returns to normal. And anybody who did something kind of too close to the line is be taking a risk that they might be, they basically might be sued under the False Claims Act. So I think, my advice would be not to do that, but especially since they make clear under the program that you're not supposed to be using this money to pay off existing facilities.
And John, that makes me think of also some of the advice we've been giving borrowers with the PPP is obviously critical to any of this is going to be the tracing and segregation of these funds, or at least keeping very, very good accounting records so that you can defend how these funds were used and deployed. It's an issue that has come up particularly with smaller businesses in the PPP program, but there's so much now potential back-end audit and inquiry that'll occur regarding the deployment of the money, how it was used, how it was spent, that, I think to your point, some of those questions about, if a business had liquidity to pay off the term loan that was coming due at or near the time, how do you show that the funds from this particular loan were not being used to pay it off, and that was, coming from a separate obligation? There's a lot of issues, it seems like, that are wrapped in there that will require fairly detailed accounting records to make sure you can defend it so that, to your point, you're not bumping up against that line of potentially crossing over into the prohibited practices.
I think that's right.
All right. Again, feel free to shoot in questions as they come up. We'll now shift a little bit and talk about some of the bank implementation concerns. I'm going to turn to Craig to lead us off on this, because particularly as a result of some of the output of the PPP program, what we have seen, and there's a Good American Banker article coming out today on this, is the goal was speed with the PPP, and so as a lender, very similarly here, that the idea is to create liquidity, address the immediate needs of the U.S. economy, deploy these resources where they're needed for those businesses that are struggling. The natural offshoot of that, of course, is in an effort to create speed, you potentially run across some pitfalls, both regulatory compliance as well as compliance with the terms of the program and some of the nuances of the programs themselves. We've already started to see a little of the Monday morning quarterbacking regarding the PPP, and I think it's fair to say, there may be similar scrutiny with this program, meaning, regulators going back and looking at how you deployed it, any of the issues that came up with PPP regarding, how you presented this to borrowers, how you prioritized individuals, how you conducted your underwriting to the extent it's not consistent with your traditional commercial underwriting, all potentially come into play. The interesting piece here compared to the PPP is it's really not considered to be part of a grant program. Instead, the concept is you're going to underwrite the lead lender or the lender's interest in the loan very similarly to how you'd underwrite a commercial loan typically. One of the issues we'll talk about here in a moment when I turn it over to Craig is this, very, I think, prescient question of, are we going to have full underwriting associated with this? The existing term sheets are somewhat silent on that fact as to what level of underwriting is necessary, other than guidance to say that the bank should deploy underwriting similar to what it would for any other commercial loan. And then there are certain factors to be considered as the bank begins to underwrite these the various Main Street programs. That said, the observation that has been made by a number of critics is if the bank is able to, through the participation process, send 95% or 85% with the priority loan facility to the Fed, what really is the bank's interest in accurate underwriting? And that's a little bit about what we'll talk about here in a second, how those various forces could come into play. So Craig, at this point, I'll turn it over to you to kind of talk a little bit about those bank obligations.
Thanks, Brad. So to build off what Brad said here, when we have a program of this size being rolled out this quickly with the limited guidance around implementation that we've seen thus far, from a regulatory and compliance perspective, it starts to get concerning that how to best prepare yourself for any regulatory challenges or litigation challenges that you have. So over the next couple of slides, we just want to reinforce that you should be looking at not only how to get the program going, but also looking down the road. What's going to be your challenges around this program in 6 months and 12 months, and how to best prepare yourself for that, how to build ammunition for any regulatory attacks or litigation attacks that you start to see as this program is rolled out. So as Brad was saying, specific obligations and processes required for proper implementation is still being considered, and we're getting guidance coming out at a rapid pace. We do have basic obligations that lenders must and should be building into their program rollout. These include what we have on the screen here. The bank will be acting as a lead lender. It's responsible for underwriting the loan and is a legal holder of the debt. If the borrower has an outstanding loan with the lead lender as of December 31st, 2019, the lead lender must confirm such loans had an internal risk rating equivalent to a pass in the FDIC supervisory rating systems. The lead lender is responsible for the documentation. Obviously, this is a large concern given the fact that we don't even know what that documentation looks like. We're still looking to the FRB to see if we'll get model forms or checklists around the origination processes. The lead lender is responsible for properly servicing the loan, dispersing payments to the FRB, and monitoring the borrower. So with these, even though it's minimal that we know about the obligations of the bank, they should start to form the fundamentals of procedures that you're building out for the program, and kind of start to get this in a documented procedure for the bank, and start to create a timeline for the guidance that's coming out. So if challenged, you can at least have the narrative around we learned X at X date, and this is why we responded in Y fashion on that date. You want to start to build evidence that you can rely on if you're in an exam and that your processes or your procedures are being questioned, or your activity under the program is being questioned by your primary regulator. Next slide, Brett. The application process is still a big question mark. We're still waiting guidance as to what exactly the application will look like. We have seen guidance that includes how an eligible lender should evaluate a borrower's creditworthiness. It's kind of vague even with that. Statements have included that eligible lenders should view the eligibility criteria in the term sheet as minimum requirements for the programs. Each eligible lender is allowed to exceed those minimum requirements. You're expected to conduct an assessment of each potential borrower's financial condition at the time of a potential borrower's application, but what does that assessment look like? What do the underwriting processes look like? We still don't know. You as the lender will apply your own underwriting standards in evaluating the financial condition and creditworthiness of a potential borrower. To Brad's point, underwriting is used a lot within the FAQs and the guidance we've seen, but no standards. We just know that what does that underwriting encompass? What is the regulator looking for us to do? And the way the vagueness of it is kind of telegraphing that the regulators are looking to sidestep any argument that we were only following the guidance we see from the FRB. So it seems like they're trying to keep that as vague as possible. Next slide, Brian. The participation agreement is also still a big question mark. We're awaiting guidance as to what exactly the participation process will look like. One of the questions asked in some of the guidance asks a question of what loan documentation is required to sell a participation to the Main Street SPV under this program. The only answer we got in that question was information regarding to the loan documentation required to sell a loan will be made available on the board's website. That's still up there today, so we're monitoring, and we'll be rolling this information out as soon as it's posts. We do know that there is no limit to the volume of participations in the Main Street SPV can purchase from one single eligible lender. Next slide, Brad. And pitfalls. Just like with the PPP program, we can anticipate challenges that the program will create. For example, the bank must be able to properly underwrite the loan and obtain documentation from the borrower and retain documentary evidence in an enforceable way. This is what we mean by, propping up the program with mature and robust procedures. you want to make sure that, if you're missing a piece of underwriting or a borrower claims that, you had an obligation to review them to a certain standard, that you have procedures to evidence that you did if it's missing from a file 12 months from now. Or if your underwriting is being attacked by a regulator or the FRB directly in 12 months or 6 months. You want to be able to point back to something that says, look, we did have standards, we did roll this out. Given the time frame, the response was as robust and as mature as you could possibly expect. You don't want to be caught flat-footed and, being reactive on any allegations of a process break in the underwriting origination process, especially given that the guidance is so minimal. You want to look as proactive as possible. Also, generally, failure to adhere to the terms of participation agreements can lead to claims by the participating lender. It may or may not be a real risk to the Federal Reserve. We're still waiting to see how this rolls out, but we do need to be aware that there are certain risks with participation agreements. And also those last...
Craig, to that point, it's very similar to how we viewed the PPP, which was, every bit of guidance that came out about the PPP was indicating that there'd be very little exposure of the bank in terms of how it conducted the program. Now, after you saw some bad headlines that came out and we moved into PPP2, there's now a renewed focus on going back and auditing the borrower certifications, auditing the borrower documentation, looking at banks and how they rolled out the program, looking at how they were qualifying individuals and whether they had reason to know of certain problems in the documentation. And so, query whether the Federal Reserve as the 85 or 95% participant would actually enforce the terms of the ultimate participation agreement. I think that's still up in the air, but I think the concept of these would be almost non-recourse participations where there are no potential exposure for the lender. We may not get the full 100%, spike the football at the goal line model there, and there's not only potential risk to the borrower, under as John mentioned the False Claims Act, but also potentially there might be scrutiny of the lenders for how they deployed this program too, or how they're servicing it, how they're keeping up, whatever the obligations are that ultimately are included in the participation and servicing agreement.
And to Brad's point, we did highlight 4 risks there that you could be exposed to as a lender under the program, and making sure that your institution is properly providing for controls around those 4 issues we're raising there. And I think back to you for the next slide, Brad.
Yeah, and before we leave that, one of the things that we have noted with some of the other CARES Act programs is you really need to be thinking about focusing on these now before the program goes live. Obviously with the close date of September 30th, assuming it came out tomorrow, we have at most then 4 months and 3 weeks of Main Street loan facility. Likely we're probably looking at a 4-month period that, from when the final guidance is issued, assuming it's issued sometime in May. And so if you're planning to participate as a lender, you need to make sure you're moving forward with making sure you have policies, procedures, and controls in place to deal with servicing, reporting to participants, making sure you have the capacity to do participation model accounting, that you've got the ability to service not only the commercial loans, but also to deal with reporting and obligations to the participant lender on the back end. And then also, just as you think about it, these are, if you particularly are a community bank and may not have significant commercial loan portfolios, or regularly do participations, now is the time to be planning for that, planning for how you're going to service and report, assigning individuals and making sure they're fully up to speed on how these types of loan programs work, and understanding that there's ongoing guidance being issued by the Fed for these. As we talk about FDIC, there is some existing guidance on their examination of participations and what they're going to be looking for. We've put that here. It's still unclear to what extent the Fed is going to try to model this after traditional participations, meaning are there going to be significant warranties and reps as well as a very extensive servicing arrangement put into place for those of you who may already be doing commercial participations. Obviously, there's a debated level of detail to which you would do you would engage in that servicing. But the big issue is making sure those clear policies and procedures are in existence and prepared. How are you doing your assessments? Have you communicated issues with the loan to the participating lender, or alternatively, have you exactly mirrored the qualification criteria to ensure the validity of the participation? Meaning, if the Fed eventually does a detailed term sheet or actually puts out a model participation agreement, the terms through which they would purchase these, have you exactly mirrored it? Are there any concerns that could potentially violate the participation agreement? That would either lead to, depending on what the Fed ultimately decides, either recourse or potentially claims or lack of revenue split. And then, mostly are there issues regarding the servicing? This is the biggest challenge with participations, because in essence, both the Fed and your bank will be relying on your servicing team to service these appropriately. And we've seen, as John and Peter noted, a number of new obligations that are imposed on borrowers who are participating in these programs regarding how they can use the money, what they can do with it. And so, there's going to be some significant servicing challenges, and you want to make sure you have your servicing staff, policies, and procedures trained up, ready to go in that regard. Yeah, I flag this just because it has continued to be a topic of controversy. American bankers, ICBA, AICPA, have come out with certain criticisms. A number of these were addressed. There's still concerns that $500,000 is simply too large of a floor to meet the needs of those interim businesses. If we look at the PPP, round one's average loan size was 206. By all accounts, round two is going to be smaller. So a lot of banking groups have expressed concern that the 500,000 is still going to leave a gap between the PPP, the sub 500 employees, and the new various Main Street programs, that would theoretically stack on top of that. One of the things we'll talk about briefly is, obviously, as John and Peter mentioned, we have now moved the index back to LIBOR, which many of us are comfortable with. The biggest concern being the Bank of England and the UK FCA have both said LIBOR is going to end at 2021. And so you may be thinking, well, that sounds good. These are 4-year terms. As I add 4 years to 2020, that's 2024 when these loans are maturing. What happens when LIBOR disappears? And the existing guidance from the Fed is you should include alternative index provisions. We still don't have a great replacement for LIBOR. We'll talk about that in a second. But all of these discussions you've been having internal to your bank about the LIBOR shift and shifting off of LIBOR, what are you going to alternatively index to and what spread? This has suddenly come to the forefront with these Main Street programs, because you're going to have to start putting alternative rates inside of these, because we do not think, at least as of now, based on what the Bank of England and the FCA has indicated, is there is no guarantee LIBOR will extend past 2021. Obviously, there's a lot of pressure to keep it in place, given the number of the amount of paper indexed to it. But at the same time, you need to be thinking about that. Finally, a lot of folks still concerned that we can't extend past 4 years. Therefore, we're going to have some pretty nasty repayment terms, particularly on the larger loans. So, query whether or not you can meet the liquidity needs of a lot of these businesses. And then there's still these EBITDA restrictions, although even under the adjusted model, they gave us some flexibility. The priority loan facility gave us a little bit better multiplier. There are still certain industry groups that are still lobbying to have those relaxed, particularly some of those in manufacturing and commercial real estate, where the EBITDA models may end up affecting their ability. I mentioned a second ago the LIBOR issue. As you're thinking about your alternative index, this just simply charts LIBOR, the dark blue, SOFR, which is the new Fed alternative in green, and then prime in red. We're doing obviously LIBOR plus 300 bips under the program, and so there are some who have thought that the Fed may be telegraphing that they want you to shift to prime as an alternative index, just because if you look historically, LIBOR is running about 300 bips under prime. Something to be aware of as you go forward. Also just be aware that if you are going to follow the Fed's guidance and shift to a SOFR index, that we have some big volatility issues in SOFR. So not only do we have that spread that we saw, but SOFR moves around a lot more. And so as you're building your models for your 15% retention or your 5% retention, make sure you understand how the shift is coming. And it's important to think about this now instead of just saying we'll just back onto SOFR, which is the Fed's preferred alternative, because you're not only going to be dealing with the rate spread that we see on this slide, particularly in the far right between the blue and the green, but also significant volatility inside of the SOFR index because it changes so frequently. A lot of commentators, I put this up, have said, some people are thinking about indexing these things to a spread over the 2-year Treasury or a 5-year Treasury. Those on this chart tend to model a little bit better onto LIBOR. But as I say, the 300 bips over LIBOR may indicate that the Fed is looking at something around a prime rate. But something you need to be thinking about with your commercial lending teams and your enterprise risk officers right now is how you're going to model for that risk of the LIBOR discontinuation in 2021. Lastly, we'll talk very briefly about the participation before we close out here is, understand that, with the 5 or 15% participation, there are basic rules under the FASBAs that obligate you relating that participation. These should be picked up in the participation agreements. The Fed in their latest update has indicated that they intend to follow this and have true lender or true sale treatment under the participations, meaning that once you sell that 85% or 95% to the Fed, it is fully transferred, true sale treatment. Both parties will then respectively either add or remove it from their accounting records, and every dollar that comes in is then distributed in portion to the relative participations. There can't be any first in, first out, or last in, first out. Everyone has equal rights to the payments that are coming in from that particular borrower. Query whether or not the 5 or 15% retention is going to be enough that it's going to concern banks significantly about underwriting. I think it will, particularly in the 15%, but this is one of the criticisms that a lot of borrowers have leveled. And so, as bankers, we need to be thinking about how are we going to be underwriting these? And it's not just simply the fact that we're going to chunk these over into the participation. We need to be thinking, particularly with 15%, is how will this affect the long-term performance of this paper? How are we going to account for it, or how are we going to underwrite it? And so, in light of that, fully expect the Fed to give some fairly detailed underwriting guidelines at some point because of the very little participation, either 5 or 15% that'll be held by the primary lender. Finally, make sure you're thinking about the costs of servicing and preparing for this. You get 25 bips of the principal amount, annually for the retained participation. So there's a little bit of money to cover your servicing, but understand, in addition to what we expect to be normal participation servicing, you're also going to have to enforce these restrictions on dividend and stock repurchases, the compensation restrictions, or at least, looking at the borrowers to ensure they're compliant with that, as well as, in some way determining reasonable efforts to maintain payroll. All of those are going to add to your servicing obligations. And so as you think about whether to deploy Main Street loan facility or not, be thinking about these particular concerns and the effect it may have on your institution, particularly with these enhanced servicing costs. And the time is now to be putting this in place, how you're going to look at this, who's going to be in charge of it, because odds are sometime during this month, we're going to get another chunk of information deployed on Main Street lending, and it'll be very close to the launch period for the window to sell the participations. And so if your institution is looking to participate in this, which we expect a lot will, given the desire of so many borrowers to create liquidity, we would fully expect that there'd be a very short turnaround before the launch of this program. With that, that kind of concludes the substantive portion. We'd certainly welcome anyone to send in their questions in the question portal. I'll turn it back over to our presenters today and just ask if you have any final comments or thoughts to sum up here. Okay. Well, we thank everybody for attending. We'll stay on the line here for a bit to take any questions that may come up. We really appreciate each of you and what you're doing to try to help the borrowers who are being impacted by the COVID-19 crisis. And, we look forward to helping you as you work through the deployment of the Main Street lending facility programs and really working to help these borrowers keep liquidity. it really is the interesting challenge, and yeah, we appreciate all that you guys are doing. So with that, we'll conclude today's presentation, and we'll stay on the line here for another 5 or 10 minutes in case any questions should come up. Thank you for attending.
Thank you very much.
All right, seeing no additional questions, thank you so much, everybody, for attending. We look forward to hearing from you on Thursday or spending some time with you. We'll have a webinar on Thursday on various forgiveness programs under the PPP and how you should be advising borrowers, as well as an information session for borrowers about the PPP loan program and how you should be thinking about the deployment of those funds and maximizing the forgiveness under the PPP, the Paycheck Protection Program loan program. So thanks, everybody. Look forward to talking with you on Thursday.
Thank you.